Hi, and welcome to my monthly Market Insights video. My name is Dan Timotich. I'm a managing principal and a portfolio manager at T2 Asset Management. Before we get started, this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of others. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, before I get started into my outlook, I just wanted to wish everyone a happy Thanksgiving, and I hope everyone has a wonderful holiday season this year. Since I'm making this video in mid-November, I will not be putting out a video in December, but I will be back in January. Okay, I think by now most of you know that the Fed is creating bubbles everywhere we look. The last couple of years have seen some unprecedented amount of stimulus, and it doesn't seem to be letting up. At this point, you will have to pay the piper at some point, and that's going to come in the form of inflation. The Fed just announced that it's going to begin tapering its bond buying program. It's going to reduce the amount of bonds and mortgage-backed securities that it buys from $120 billion per month to $105 billion per month. Sounds great, right? So instead of buying $1.4 trillion a year, they're going to only buy $1.3 trillion per year. So much for allowing the natural price discovery in the bond market. And while the Fed is tipping the scales of price discovery, it is allowing the federal government to continue spending outrageous amounts of money. President Biden just signed a so-called infrastructure bill with a price tag of $1.7 trillion. Add in the trillions upon trillions that have been spent over the last couple of years, and you're talking about real money. If the Fed doesn't keep interest rates low, there is no way the Fed's going to be able to, or the U.S. is going to be able to service its debt. Just imagine what the price tag would be on our debt if the interest rates were at 5% instead of 1.5%. But just like any infomercial, that's not all, folks. The Fed's policy is causing a housing bubble to develop rapidly. Wage pressures have been building and continue to build, and all of this has allowed inflation to take hold. This month, I'm going to focus on these last three points in particular. So let's take a look at housing. Here's a chart showing the rapid rise in house prices in the United States. As of the most recent reading, it looks like housing prices are up about 12% from a year ago and rising rapidly. Here we have another chart. This one's from the Federal Housing Finance Agency. FHFA House Price Index is the nation's only collection of public, freely available house price indexes that measure the changes in single-family homes based on data from all 50 states and over 400 American cities, and it goes all the way back to the mid-70s. As you can see here, U.S. housing prices are up over 18% and are over 20% in different parts of the country, and it's surpassing the housing bubble peak of 2007 into 2008. And while inflation numbers are coming in hot, they still don't reflect the housing implications. Why? Because CPI uses what's called the owner's equivalent rent. The problem with this is that the owner's equivalent rent typically lags home prices for about a year. So this will be another factor that keeps inflation elevated and not as transitory as the Fed may want it to sound. Now let's take a look at wages because most economists, they don't believe that you can have persistently high inflation unless you see wage inflation. So here is a chart showing the employment cost index for the private sector. And as you can see, wages have been rising rapidly ever since the pandemic. The other day I drove by a Wendy's and they're offering $500 signing bonuses, trying to entice workers. Others are offering tuition reimbursement, flexible hours, $15, $20 hourly starting pay, etc. If anybody thinks that this is going to go away in a few months, they're kidding themselves. Employment costs are going to continue to rise, and it's going to continue to add to inflationary pressures. So let's take a look at the so-called transitory inflation. We just had a CPI print that shows inflation is up 6.1% year over year. At the beginning of the year, the Fed said that this was transitory. I guess the word transitory no longer means temporary, since inflation has been increasing every month since November of 2020. If we pull the lens back a bit, you could see that we haven't seen this kind of inflation since 1990. That's about 30 years ago. Maybe, just maybe, the combination of easy monetary policy over the last 20 years coupled with the insane fiscal spending is starting to show up in the numbers. And as I was starting to think about this, I thought it would be useful to research history a little bit. As most of you know, I'm a big fan of going back in history and trying to draw some parallels. Most people think that the 1970s great inflation can't happen again, and I think they're right in some respects. But I wanted to see what the Fed did back then and see if we could draw any of these parallels to what the Fed is doing today. The Fed chairman back in 1970 was Arthur Burns. He was an expert in business cycles and by many accounts ruled the Fed with an iron fist. He was a data junkie that tried to segment problems because he really lacked an analytical framework to assess the impact of monetary policy on the real economy and inflation. When inflation began to show up in the 70s, Burns was adamant that it was transitory. Today, Fed Chair Powell pretty much saying the same thing. Burns also believed that price trends were influenced by outside factors and had nothing to do with monetary policy. Today, the Fed seems to echo the same sentiment. The reason for inflation today is because of the pandemic, and it has nothing to do with monetary policy. But Burns didn't just stop there. When the price of oil and other energy-related products started to rise, he simply told his staff to take it out of the CPI calculation, even though it represented about 11% of CPI. Then food prices started going up. No problem, we'll just take it out. It's only 25% of CPI. Home prices skyrocketing. Nothing to see here, just take it out. By the time Burns was done taking out all the things he didn't like, only 35% of CPI components were left, and they were still rising at double-digit rates. Throughout the entire process, Burns maintained that inflation was just transitory. It sounds awfully familiar to what's going on today. So let's fast forward to today. Prices are rising across everything: food, construction, cars, gas, rents, appliances, etc. Powell continues to maintain that it's transitory and it's because of the pandemic. And with all the problems facing the Fed in the 1970s, the real problem was when the Fed allowed the real interest rates to go negative. By 1975, even Burns had to concede that inflation was not transitory, but it was too late. Today, the Fed has allowed real interest rates to go negative and really negative. Inflation is running about 6% and the 10 years around 1.6%. That means the real interest rate today is negative 4.5%. Now, look, I'm not saying that we're going to relive the great inflation of the 70s, but you can learn a lot from history. If inflation persists, which I think it will, the Fed is going to be forced to increase the rate at which it tapers. This is going to lead to raising interest rates sooner than everyone expects and cause the economy to slow. A higher 10-year Treasury yield is going to cause stock prices to reprice lower, and given the high valuations and less optimism on the economy, this could cause much bigger problems in the next year or two. Now, I used this same chart in my last video, but I think it's important to repeat. Investors need to know what's coming in order to make proper investment decisions. Far too often, people look back on a crisis and ask why nobody saw it coming. I just went through a number of factors that can be seen as warning signs. It doesn't mean that we are in the direct path of a Category 5 hurricane, but it does mean that we should be prepared to react to an environment that may not be as great as it appears. Maybe the Fed is right. Maybe everything's going to work out well. But what if they're wrong? If you're young enough and have decades until you retire, you should be fine. But if you're approaching retirement, it may be time for you to reduce some of that risk. The year of the pandemic, 2020, the S&P 500 was up 16%. So far this year, the S&P 500 is up about 25%. The average return for the S&P 500 since inception is around 6-7%. Are we really saying that we are in a better place today because of the pandemic, or is there something else driving these returns? Could it be that the market is drunk on liquidity and too much money is pushing stocks higher? What happens when the Fed is forced to take away the punch bowl sooner than people expect? These are very important questions that each investor has to ask themselves. There's nothing wrong with taking some gains, reducing risk, and being patient. Maybe you miss out on some of the upside, but given the risk in the market today, it's a small price to pay if the market rolls over. Yes, being conservative today has an opportunity cost, but the alternative may prove to be much more costly. Well, I hope that was helpful. Once again, have a wonderful Thanksgiving. Happy holidays, and I'm going to be back in January to kick off 2022. Thanks again for watching.